Ray Dalio, founder of Bridgewater Associates, has become a well-known macroeconomic investor, gradually transforming it into the world's biggest hedge fund. When Dalio speaks on investment, the world takes note. Recently, in an exclusive 25-minute interview with CNBC, he shared his current perspectives on the economy, short and long-term debt cycles, and market trends over the next few years. With inflation rates on the rise, a weakened economy, and falling stock markets, Dalio provided his opinion on our current position in the economic cycle. Ray Dalio describes a recurring economic cycle that has occurred 12.5 times since 1945. He believes that the cycle involves a new monetary system followed by an economic weakness, government intervention through distribution of wealth, and an imbalance created by the injection of money into the system. This leads to inflation and a tight monetary policy. Currently, the economy is in a classic spot where the real interest rate is relatively high and cash is attractive. This is due to a move from the right to left and the COVID-19 pandemic, which prompted the government to send out checks funded by the Federal Reserve. There is no doubt that the boom times are over. Following the height of the short-term debt cycle, we are now in the contraction phase. Before the epidemic, the last decade saw good times. Because borrowing money was affordable and interest rates were low, the economy grew and people were optimistic. Unfortunately, the economy experienced a big jolt in 2020. There was internal political strife in the US, which was followed by a change in political power, with the Democrats taking charge. To combat the economic deterioration, the Federal Reserve printed a significant amount of money. This action boosted demand and stimulated the economy, but it also sharply increased inflation. Ray further says that the economic stimulus button has been pushed as far as possible, leading to the inevitable contraction phase in the economic cycle. As interest rates rise and money becomes scarce, the parts of the economy and market that rely on cash flow and funding, such as tech stocks, private equity, and venture capital, begin to decline. The short-term cycle is now at its pinnacle, where everything becomes overinflated, and we are starting to fall to the other side of the slope. It appears that this process is still in its infancy. According to Ray Dalio, the bubble sectors are currently suffering. Investor pressure brought on by the Federal Reserve's decision to raise interest rates has caused them to pull money out of all speculative assets. For instance, all of tech stocks with negative cash flow and Bitcoin, a typical example of a speculative asset, has fallen sharply. Tighter monetary policy is also putting pressure on debt-dependent private equity and venture capital. This signifies the initial stage of the contraction phase. However, as Ray further explained, it seems that things are starting to get a little more challenging. In essence, Ray Dalio is anticipating a stagflationary environment. Stagflation is a combination of economic stagnation and high inflation. It is the situation of economic weakness alongside high inflation, which usually does not occur. Typically, inflation arises due to a booming economy, low interest rates, low unemployment, increased demand, and thriving business. As workers begin to demand higher wages for the same work, overall inflation starts to rise. Stagflation is an unusual economic scenario characterized by high inflation in a struggling economy where unemployment is on the rise. This situation is particularly challenging for those who manage monetary policy, as measures to control inflation, such as raising interest rates, will only worsen on an already bad economic situation. Ray Dalio predicts that the United States is heading towards such an economic scenario. He expects that inflation will not fall back to the Federal Reserve's target level, perhaps dropping to around 3.5%, but will then rise. At the same time, he foresees economic growth remaining low, perhaps hovering around 1% annually. These are Ray's thoughts on the present situation, which falls within the short-term debt cycle. However, in addition to the short-term cycle, there is also a long-term debt cycle that rises and falls every 75 years or so. While the focus is currently on the short-term debt cycle, Ray Dalio warns that he is witnessing issues arise in the long-term debt cycle as well. In the long-term debt cycle since 1945, there has been an accumulation of debt and money. The issue of debt is a significant matter that we deal with, such as the debt ceiling. In the past, there used to be a free market supply and demand, but now the Federal Reserve has stepped in and is buying it on the balance sheet, which disrupts the supply-demand dynamic. Ray Dalio believes that people are not giving enough attention to this big cycle. Since World War II, the short-term cycles have averaged about 6 or 7 years, plus or minus 3 years. Currently, we are in a classic short-term cycle, but the debt keeps building up, which poses a problem in the long-term cycle. It is likely that you have come across reports about the United States facing not only immediate issues, but also a significant increase in its national debt due to the economic turmoil caused by the pandemic, particularly the enforced lockdowns that disrupted employment. To provide financial support to the people, the US government had to rapidly infuse a large sum of money into the economy through various means, such as stimulus checks and extensive investments in areas such as infrastructure projects, which were intended to generate employment opportunities. The question arises as to how the government obtained the required funds for these investments. In order to finance these expenditures, the government sold new government bonds to the Federal Reserve, which printed approximately $4 trillion in what some might call new money. This action resulted in the current rampant inflation we are experiencing. However, despite these measures, the US government continues to spend more than it earns. And with the existing debt ceiling already being reached, it is no longer possible to substitute old debt with fresh debt. As a result, there is a non-negligible probability that the government may default on its debt, which could initiate the start of a long-term debt cycle's downward trend. The United States is grappling with the issue of diminished global demand for their recently issued bonds, which further compounds the existing problem. In summary, although a crisis has not yet occurred, certain actions are in progress that could initiate the decline of the prolonged debt cycle. He sees this recession as not as severe as anticipated due to the way it is distributing and shrinking credit. However, the United States' debt is a significant concern as the country has borrowed a substantial amount of money and geopolitical factors are weakening demand for US bonds. Looking at wealth instead of GDP provides a better indicator of the economy, as GDP only measures revenue. It is intriguing to note that Ray is genuinely taken aback by the fact that the economic downturn has not been as severe as he had anticipated. However, as we had previously discussed, his tone of voice suggests that he is genuinely worried about the future due to several factors such as the United States national debt, the current deficit, the debt ceiling, and the declining demand for US bonds. Ray points out the biggest issue, and that is the US government is spending more than it earns, which poses a problem. While governments can print money or tax to make up for the shortfall, both options have downsides. Cutting spending is difficult in the current environment, where initiatives like defense, the green agenda, and education require significant investment. As a result, there is a dilemma that the country is facing in terms of balancing spending and revenue. So, how does Ray propose to solve this problem? He said that the problem of spending more than earning can be addressed by investing in areas that will produce returns, such as education and infrastructure. These investments can improve productivity and address substandard conditions in certain areas. However, this issue is part of a larger cycle that has repeated itself over time. To put it simply, spending more than what you earn always leads to trouble. This practice necessitates continued borrowing, which eventually leads to the present scenario, where debts are exorbitant and uncontrollable. Finally, here is Ray Dalio's thoughts on where the stock market sits at the moment and whether he sees it falling further. Ray believes that the stock market has already priced in the impact of the interest rate changes and other market impacts. He suggests that the market may now face a tighter monetary policy, which is a net negative for the stock market, but not a major bearish issue. Ray thinks that the market is now closer to being fairly priced, although still a bit high considering the overall situation. To sum things up, Ray Dalio believes that despite progress has been made, there are still potential issues looming on the horizon. As a result, he anticipates continued pressure on the stock market in the upcoming years. Overall, these are his updated insights regarding the United States economy and recommendations for addressing them. Do you agree with Ray? Share your thoughts with us in the comments below. Thank you so much for watching. If you haven't already, click the like button and subscribe to our channel and turn on notifications to stay updated.